Let me tell you something most trading videos won't tell you. Becoming profitable has very little to do with finding the perfect strategy. It's not the indicators, and it's not some secret system. I know that because I spent almost 8 years chasing all of that myself, but getting good at trading is all about mastering the 3 things most traders never focus on, and more importantly, learning how they work together. In this video, I'm going to show you the framework that finally made trading click for me after almost 8 years. Let's start. Now, here's the pattern that I see over and over again, and maybe you'll recognize it. Someone decides they want to learn trading, so the first thing they start doing is finding a strategy. And they could find one, it could be anything, a YouTube video, a course, or a book. And it makes sense, it looks good on the chart, and they get excited. So excitement comes after. They start trading it, and for a while, it almost works, and at some point, it stops working. A losing streak might come, 3, 4, 5 losses in a row, and suddenly they're not sure if the strategy is working. After the loss, what happens is they're now looking for a new strategy. And what happens after is the cycle repeating itself. After that new strategy is still failing, what's going to happen is it repeats, and that's the loop. That's the cycle that they repeat, a strategy, excitement, loss, a new strategy, and then repeating the same cycle. Now, I'm not describing someone else here, I'm describing myself and most of the traders here. I was stuck in this loop for a long time, moving from one phase to another in this loop without making any improvement. Now, that's what this video is about, not a new strategy, but the foundation, the 3 things that have to be in place before any strategy can actually work, and how they connect to each other. So let's understand the 3 pillars of a profitable trader. 1. The first one is going to be an edge. Now, all of these are going to be gone over in detail. 2. And then the psychology. 3. And risk. The moment you have all of these 3 working together and in the right way, then nothing can stop you. And this is what I'm actually trying to teach you in this video, part 1, edge. Now, here is something that took me way too long to see, that every strategy you might think about, so let's think about ICT, smart money concepts, support and resistance, supply and demand, and also if you think about the general ways or the big ways of trading, which are, for example, continuation trading, reversal, and range. I mean, any strategy you could be thinking of is going to be, one of these, so all of these, when we take out the name, or the indicator, or the time frame, what's left is always the same, price is at a key level, reacting off a key level, into a key level, and reacting off a key level. So if you notice here, key level reaction, key level reaction. Now, we could have some other key level inside here, inside the range, but key level, and the reactions are going to be at the key levels. Before we continue, everything I've learned over the last 7 years, the framework, the system, and how to read the market, is stored inside my community, Edge School. That includes the Edge model, the same strategy one used to find those 5 to 1, 10 to 1, and even 20 to 1 reward to risk trades. Live with the community. If you want to learn my full system, the link is in the description. Let's keep going. So that's it, price moving from a key level to another, and from a key level to another. Now, when you focus on the strategy itself, it's your method of identifying which level you're looking at and when to enter that move. So that goes into the strategy, but all of the strategies you could be thinking of are based on the same thing, a level to another. Now, when you focus on the strategy itself, it's your method of identifying which level you're looking at and when to enter that move. So that goes into the strategy, but all of the strategies you could be thinking of are based on the same thing, a level to another. So the question is, if every trade is just price moving from a level to another, what do you actually need before you take it? 3 things, and these are the only 3 pillars of a trading system. I mean, every trading plan you could be thinking of relies on these 3. Now, we could have more details and more confluences below each one, but these are the main 3. Direction. Direction answers the question of which way is price most likely to move from where it is right now. Key level, where is it coming from? Where is it going to? These are your boundaries. So these 2 things are your boundaries, and this is the understanding of the key level, entry, where exa. Entry, where exactly do you get in early enough that the math works in your favor? And we're going to be covering the math, we're going to be covering the reward to risk, the win rate, and everything you need, so these are the 3 pillars of a trading system. The moment you can define a direction, a key level, and an entry, you have a valid trading system. If you cannot answer all these 3 before you enter a trade, then you don't have a trade. Now, here is one of my big realizations after years of trading. Trading is all about finding a high probability range. A high probability range means a zone where continuation is more likely than a reversal. The moment you identify this, then there is a potential trade, and the whole process becomes easier. So, what is a high probability range? For example, a high to a low. What we are finding, or what we are coming to a conclusion out of this, is that because this is a high probability one, it means we're going to be having a continuation from, and the continuation is going to be to the downside. So the moment price goes back into the range, which is a zone where continuation is more likely than a reversal, so I know that price will continue lower from here. So the moment you identify the range, that process is simply you trying to be in the right place, at the right time, and with the right size. Now you may ask, what is the easiest way to identify a high probability range? My answer is this formula here. Weakness could be in a lot of different shapes and forms. Strength is the same as well. Now, the moment we have this sequence, AW to S, or weakness to strength, it's going to give us a high probability range. Weakness, one of the ways that we can see it, and I mean the easiest way, is a fake out or failing to displace. So simply, we have price going up and then failing to close above this, immediately going lower, that is a weakness. Strength, range. My answer is this formula here. Weakness could be in a lot of different shapes and forms. Strength is the same as well. Now, the moment we have this sequence, AW to S, or weakness to strength, it's going to give us a high probability range. Weakness, one of the ways that we can see it, and I mean the easiest way, is a fake out or failing to displace. So simply, we have price going up and then failing to close above this, immediately going lower, that is a weakness. Strength. Then we have a high probability range, so, for example, we have this price action range here. Now, we want to find high probability ranges and then look for the continuation out of these. So, for example, if we focus on here, what we have is a weakness followed by strength. So it's this formula right here, weakness, strength, that means we have a high probability range from here to here, and that's where the continuation came from. Now here, we have a weakness followed by strength, and then we have this high probability range, and then a continuation from here. Same thing here, we have a weakness, strength, and then the continuation comes off here. So if we decide to open any chart and then look for this specific formula, the weakness to strength equal a high probability range, that means if I can see that here we actually failed to close below, then we had only one closure and then going above, then we have a strength on the opposite side. So we have weakness and strength, into the range going lower. Strength, retracement, and then continuation. Weakness, and then strength, followed by a continuation after the retracement. And this will keep happening every time. So weakness, and then retracement after the strength, continuation, weakness, strength, continuation. And that's the pattern here, that's the formula. Now, a setup is a single trade idea. An edge is something different. An edge is a repeatable statistical advantage across hundreds of trades, and not just one. Now, there is no certainty in trading, so you don't know if the next trade will be a winner or a loser. You cannot even know. What you can know is that if your edge is real, that over a large enough sample, the math will pay out, and there is a formula that tells you if your system has an edge or if it's going to be profitable, and that one is expectancy. So if that number is positive after this formula, which has the win rate and the average win, the loss rate and the average loss. So what you can, the conclusion from this is that in order to become a profitable trader, what you need is a high win rate and then a high average win, in other words, a high reward to risk ratio, so if the number is positive again, then you'll make money over time. If it's negative, it does not matter how good your entries look, even if you're having sniper entries and, you think you're going to make money, you are not. You're just going to be losing in slow motion. So if we do the math here, if we have a 30% win rate and a 3-to-1 reward to risk, that's going to give us a positive expectancy. That means you'll be making money over time. However, if we have a 40% win rate and a 1-to-1 reward to risk, it's going to be a negative expectancy, and you'll be losing money no matter how good it looks. Part 2, Psychology. So now talking about psychology, but not the way everyone talks about it, because it's mostly wrong or incomplete, in other words. Now, every trading book gives you the same list: FOMO, overtrading, revenge trading, and then another time they say impatience, moving stops, and the list goes on and on. So a lot of, there is discipline as well. What the book is going to tell you is that do not do this, be disciplined, have a plan and stick to it. But that does not work. Because you'll tell yourself, I'll be more disciplined, and then the next loss or the next trade that you take, you are not disciplined, again and again. Now the thing is, all of these things that you are seeing here are just symptoms. They are not real issues. All of these go back to the same root, and that root is your nervous system. Your nervous system does not know the difference between a losing trade and being chased by something dangerous, it's the same thing. To your body, clear, and it does not lie. It shows you exactly who you are when the pressure is on, so what do you actually do with this, the root thing? You need to stop trying to fix each symptom individually, because that's an endless game. You'll be fixing one, and then another will show up tomorrow, so it's not going to work. What you need to do is fix the root, and 90% of the issues start dissolving on their own. Now, one more thing on this, and it's very important, a lot of people misunderstand this, and this is something I've learned after years of trading. Now looking at this table here, we have a loss, a win, followed process, and broke rules, outcome process assessment, loss followed process good trade, loss broke rules bad trade, win followed process good trade, proud, win broke rules most dangerous trade, a losing trade that you executed perfectly, right entry, right size, and everything is right, you followed your plan, but it's a loser, that's a good trade. Now, a trade you took and it was a loss when you broke your rules, that's a bad trade. And I would say this is not too dangerous as the other one that we're going to be discussing here. Now, a trade that was a win when you followed your process, that's a trade you should be proud of. But the dangerous part here is this one here, a winner that you got when you were breaking your rules, that is the most dangerous trade, because now your brain has evidence that breaking the rules works. And that's a problem, a big problem actually, that will show up later in maybe a worse timing. So you want to focus on what is above, following the process regardless of the outcome. Part 3, Risk. Now, we know that every trade you take is a probability event. You don't know if it's going to be a winner or a loser, actually, no one does. What you do know, and what you can actually control completely, is how much you expose to that uncertainty. That is the only variable you can fully control in trading. There is nothing that you can control, only the risk, only the question of how much that you can actually control. Now, let's talk about asymmetry. And we have this table that has a win rate on the bottom here, and to the left, we have the reward to risk, high and a low win rate and a high win rate. Now, a lot of people start here, which is not a good zone to be on, and most likely you'll be a lose. You expose to that uncertainty. That is the only variable you can fully control in trading. There is nothing that you can control, only the risk, only the question of how much that you can actually control. Now, let's talk about asymmetry. And we have this table that has a win rate on the bottom here, and to the left, we have the reward to risk, high and a low win rate and a high win rate. Now, a lot of people start here, which is not a good zone to be on, and most likely you'll be a loser here, having a low win rate and a low reward to risk. That means you're risking $100, for example, and you're only making $50, much less than what you are risking. And then the win rate is lower, that means even out of 10 times, you're losing 6 times. So that is a bad position to be on, and a lot of people are going to be losing. Now, a good trader would be having a high reward to risk and a low win rate, that could still work, but it's going to have a bit more pressure here because the win rate is lower. Also, a good trader could be having a high win rate and a low reward to risk, but the position that you want to be on, and the best one, it's going to happen after a lot of years in trading, and the moment that you can be precise and more picky with your setups, it's going to be right here. This is the zone where it should be the goal to your trading journey. And here's where you're going to be feeling like trading is going to be more like a business, you're becoming more as a professional trader. And it is when you have a high reward to risk and a high win rate. This is a simple chart showing the relationship between the win rate and the reward to risk, and what it needs to be a break-even trader. For example, if you have a 1-to-1 reward to risk, you need a 50% win rate in order to become break-even, and below that, risking 2-to-1, 3 to 1, 4 to 1, you're going to be making money. On the other hand, if you do less than that, you'll be losing money. So this is something very important to be aware of in order to know, based on your numbers, the reward to risk that you are having and the win rate, how much you need to stay break even and how much you need to make money. Now, here is the drawdown math that maybe a lot of people don't know about, and they never thought about. So we're having here loss and then the recovery needed. If you lose 25% of your account, you will need 33% to go back to break even. Now, this is a bit annoying, but at this point, it's fine, it's not a big deal. If you lose 50%, you need 100% to make it back to go back to break even. You know, that's a different situation here. Now, if you lose 75%, you need 300% to make it back, 3 times your remaining capital. And I guess for most traders, that account is essentially over, that's where most people just quit. So what this teaches us is that a good strategy is not only about maximizing the returns, it's not just about making more money, but the main goal, and what's more important, and this is what's going to make you survive in the long term, is protecting the base that your returns can compound from. So I'm going to be starting small, and then I'll protect the base, because that's where I want to start from. If I go below that, it's going to be much harder to make it up. Now, one important thing is that an edge only works if you're still trading when the statistics play out. So I cannot just take 10 trades and then come to a conclusion that I have an edge. No, it needs to be across a big number. So let's look at a comparison here between a healthy curve and an unhealthy curve. A healthy curve, if you notice, we've taken a lot of trades, that's the first thing. There are a lot of trades, and we don't see sharp moves to the downside and to the upside. So we're not making money quickly, and we're not losing money quickly. We're having a healthy climbing. It's like stairs, you know, going up and going down slowly, but overall we are going up. We're risking the same thing, sometimes we lose half of what we're making, and then making double what we're risking, and we go up slowly, slowly, slowly. Now, an unhealthy curve could be looking like this, where we're staying near the first amount that we deposited, and then we had a strong push to the upside, another spike to the upside, and then suddenly we went back to zero. So that means, we're not risking the same amount every time, and then we're not having stop losses. That is very unhealthy. How could you lose all your money from a single trade? Another one could be like this, where we have, first of all, this looks like, you know, we're looking at 10 days or, 20 days, but here we're looking at 6 months and a year, because here it's more smooth, here it's not smooth. So we have sharp moves to the upside and downside, and it's more visible here because the time is not as big and as long as this one here. Conclusion, so, the realization, and that's what I want you to take from this video, is that edge, psychology, and risk, most people treat these as 3 separate topics. It's like we have a course on strategy, another course on mindset, and then a course on risk management, so they're taught differently, when in reality, they need to be working with each other. When we talk about an edge, what it does is that it tells you what trade to tack. And then the psychology decides whether you actually take it and whether you exit correctly, and then the risk determines whether you survive long enough to see the edge work. These 3, the moment you have them, the moment you understand them, and the moment you apply them, because understanding is not everything, it's about applying, it's about execution. The moment you apply these into your trading system, then that's the end.